We have our Astor economic indicator up, and let's just get right to it. Okay, so here we go. You can see that we've ticked down a little bit more uh, since the prior month. And this is, pretty much what I would expect, because when we look at, the sharp recovery that we had, so much of that was based on stimulus that was provided by, either the Fed providing liquidity or, the government throwing out uh, actual cash into households, into businesses. And as that bled off, should have expected, some sort of slowdown. In addition to that, we've had increases in the Mr. COVID cases, and that has slowed things down also. It's very disruptive for businesses when an employee comes in and they test positive for COVID, or they actually have COVID. That can slow things down also. But the thing that I'm kind of watching pretty closely right now is the overall unemployment rate. And to put this in context, when the crisis first happened with the COVID, we lost 22 million jobs, and so we recovered quite a few. We still have 10 million unemployed. Today's unemployment numbers that actually came out today, post this chart. What was much higher than the unemployment claims were higher than what was expected. So to put it in context, if we go back to 2008, 2009, the great financial crisis, we lost, a peak of maybe like 15 million jobs, and from peak to trough, it was like 8.7 million jobs that were lost. We're sitting at 10 million right now. The difference being, the markets reflected that, and where today the markets are actually reflecting a totally different scenario. And I think that the difference is the response from the Fed and the Treasury. They threw everything they could at it, and as that kind of bled off a little bit, that's why we're seeing this decline. So the consensus basically says that what we'd see, maybe a little softer first quarter and first half of this year, but the second half of the year, as the vaccines roll out, people become more comfortable going out, going to restaurants, flying, going on vacations, we should see, a pretty robust recovery. And now that's consensus, and anytime I see consensus, I say, okay, what can go wrong? So with that in mind, how that reflects, actually affects you is when you're looking at your portfolios. I think now is a really good time to really take a look at, where you're at on the risk scale. If you're into like a fund that tracks the S&P 500, currently there are 5 stocks that make up about 20% of that portfolio, of that holding. So the S&P 500 has become much less diverse as a diversified holding. So I would look under the hood and what's in your portfolios, and Morningstar can help you, the analysis they have on what the top holdings are, and just see where you're exposed. So with that being said, we're here, we're getting ready to run into tax season here. It's going to be a bear with everything that they did last year. But we're here for your questions. We're never too busy, for you or your friends or your family, so don't keep us a secret. Again, until I see you next month, stay safe.